Hello, everyone, and welcome back to the J22 Report. I am your host, Johnnie Market. You all know that drill. Smash that like button, subscribe if you haven't. Remember the disclaimer. Nothing should be construed as financial investment advice. These are just my opinions, my thoughts on the market, and I wanted to first get into, before I share, I want to encourage you before I get into anything. I have a Substack, and this is probably one day where I'll start my newsletter or write. I might do something on Seeking Alpha soon too. Right now, I don't think anything is undervalued per se. So uh, right now, I said oil stocks below, when it was basically since January, are cheap and undervalued, and I was going to buy them. I'm not buying them anymore. 70 was my price target, and now it's gone way above that, so I'm not buying oil anymore. I don't think it's cheap anymore. And this is the one thing I want to get into. Well, first of all, this is my Substack. I want to encourage you all to go to this, because if I have periods where I can't do the videos and all that other good stuff, every now and again, like here's one bad job numbers, and this is what I think. I don't think we can create fictitious numbers anymore. I think the economy's so bad, it's going to be very hard. So you can join my Substack. It's below if you want to know where. It's below. I have it in, and I'll like retweet something too or restack. And this is one thing, is when I think oil breaks 100 and goes towards 200 or one, I do think work from home policies will return soon. Maybe not completely, but it might be like a more hybrid. They'll give you 2 days off or whatnot, because I think prices are just going to go through the roof. So we'll talk about that more. Let's see. Oh yeah, here's the one thing: auto loan delinquencies, they're skyrocketing. I talk about it. I used to think the housing bubble would come first, but I think the residential housing bubble is actually going to pop last. Because it's so many other things I think have to happen first, like auto loan delinquencies, credit cards, and I think people will start losing their jobs more. So we'll get into that before this all new inventory. Because people still think there's a shortage. Like it's not. Uh, but yeah, if you look at this 60-day delinquency rate on subprime auto loans, all time high. They are now higher than 96, peak way above the great financial crisis levels, and they've more than doubled over the last 4 years. So all this is, and then credit card. Oh, never mind. I thought that was a credit card. That's credit default. I actually thought this was very interesting. This was like from the Epstein files. I don't really want to. Anyway, it's basically a new report surfaced that, like, this is in the Epstein files. Russian IMF chief jailed for discovering U.S. gold is gone. And this is, and I used to think that, just my opinion, that there was actually gold at Fort Knox, but it wasn't as much as they say. And now I'm beginning to think, wow, maybe I was wrong. Maybe there is none there. So I'll either restack, or this is the other thing. There was one other thing, is I did a model portfolio. Look at this. This is the 22nd. Oil and energy is the only sector that is cheap and investable. Well, look what happened. Now it's up. So yeah, I do a lot of stuff, and this one I was just like doing tongue in cheek. If companies don't pay the tariffs the US consumer does, then why are the companies being refunded? Why don't they refund the consumer by giving every citizen a top line deduction on their net income tax? Or any citizen that filed taxes will get a check for X amount of money, because they are the ones that put in quotes, pay the tariffs. So just shows like, that's BS when they're like, oh, you pay the tariffs. They pass the cost on the consumer. Not all the time, and not when the consumer's broke. But uh I did a model portfolio and I want to get here it is. And this was like my model portfolio. I'm gonna go. This was one of my Trinket model portfolio. And I just have the, non-investing advice. I need to do that more, but it's basically like, I mean, do what you think's best. This is not investment advice. 20% gold and silver exposure. And, it's either royalty and streaming or like Anglo Eagles, safe miners. But I think bullion's for rich people. I think if you're rich, like you definitely should have this in bullion. And then right now I have like 40% in cash, and then some in safe banks and brokerage accounts, and then 10 to 30% of that cash should be in actual like SAT cash. I actually don't have actual cash, so that's why I say it's a model. And then at the time, 20% oil energy, that's the only thing cheap. Of course, this was February 16th, oil's gone up. And then I have like 20% in the 20, 60, 80. Then 20% stuff like utilities, Coca-Cola, Clorox, McDonald's, strong global brands, things that pay dividends. And I mean, I would say this is more 40%. And you can add royalty and streamings and stuff like that to that. So, but yeah, it's just my model portfolio for now. And I was just going to tell you about Babe Ruth. And Babe Ruth, everyone knows the baseball player, but people don't know is an investor. And most investors cannot pull off what he did in the 20s, investing wise, which was brilliant. And Babe Ruth investing dividend. And so basically what he did is I did this in a book. It's basically like they did say so yeah, they say it was annuities, but like I read a book and it was about barnstorming, Babe Ruth. Uh so you can see about his let me see. I'm just giving you the background. Yeah, it's this one. Big fella. I read this. Babe Ruth and the world he created. It's basically about barnstorming. So anyway, going back to Babe Ruth, and so what he did is in this book, it talked about investing. And so what he did is he bought treasury bonds, which I wouldn't buy today. He bought stuff like Standard Oil, railroad stocks, stuff with big dividends. And this was during the 1920s. Now he could have saved the money and bought up like most people would say, oh no, keep in cash and save the money. But what he did was he bought dividend stocks, stuff you need, stuff that's, you know, I wouldn't say recession proof, but like Clorox, people are still going to wash their clothes. Or like waste management, people are still going to do trash. That's another example. Or McDonald's will be one, Coca-Cola, stuff like that. And you got good paying dividend stocks. And even though the Great Depression happened, he made a lot of money in income investing. And I think a lot of people should try that. In my opinion, not investment advice. And they're doing this enabled him to retire, and it enabled him to get a big salary. It was like a 17,500 per year. This is the equivalent of 380,000 today. So that's what I think everyone should be doing, in my opinion. That's what I'll probably be doing when market crashes. Like all my oil stocks, are almost all of them, they have good dividend paying stocks. I would still do dabble in the juniors, but I'm not dabbling in the juniors now just because oil's more expensive. I wonder if there's going to be a pullback, but that's the thing. So let's get into a little bit of the news. Gold took a dive. I forget which day, but the Polish central bank weighs gold sales to fund defense, and that's why gold had like a big down day one day this week. And they were the biggest buyer. I've done this in past videos. It's not China and India; it's Poland, and they might do that. I mean, I don't. I'm not going to say that's dumb for selling gold because they are. I mean, a lot of European countries generally are under defense wise, and Russia's just right there on the border. So I think that would actually possibly be smart. Like, what's the point of having wealth if you can't protect it? Sometimes it's physical and not literally. So, and if you look at this, U.S. brokers a major deal with Venezuela's mining. This is going to create selling to U.S. refinery. So I think that's sort of stupid because there's a lot of U.S. probably that own gold. And I know so many gold people, or I'll go to a coin shop. There's coin shops all over the US. They used to say percentage of Americans that own gold. 11 to 12%. I remember they used to say only like 2 or 3% own gold. I don't believe that. I think it's like 20 or 30. They say because there's a lot of gold owners and they don't want you to know they have it. Yeah, millennial investors have a lot more interest. Maybe that was the case in like '08 when it was like, but yeah, I think it's 10 to 20% now that own gold. I don't think I don't think it's because like every shop, every major city I know, there are all these coin shops and you can get, so I just don't believe it's a small amount. So, and then looking in the gold market, this is the one thing right now. WTI is at 90 and Brent crude's at 92. I think the best thing to do is cash right now, in my opinion. I'm not telling you what to do or anything. Now, the stocks have not really followed as much because right now they're pricing in supply disruptions, from my opinion. So if you actually look at it, like I'm going to do XLE. Like, even though Brent crude has gone up a lot, XLE on like a 5 day, it's down like 2%. So my oil stocks have done well this week. So, and that's one reason I do want to sort of take a newsletter. This is interesting. Industry stocks are flashing a signal markets haven't seen since the 2022 crisis, and diverging sharply from the U.S. equity market as prices surge. So, so there you go. The energy is. I just thought that was going down, and oh yeah, I had it here. XLE, and one of the reasons is with the war in Iran, which I'm completely against. But anyway, I don't want to get too political. They are worried about supply disruptions because of the Straits of Hormuz. Not only that, a lot of pipelines and infrastructure and data centers are even being attacked. I don't know if you know this, uh, but yeah, if you look at it, data centers become military targets as Iran wages on. Data centers, I told you, not a good investment. So that's what I think. I mean, I was saying, oil stocks were a great buy on this channel. great buy, but when price changes, I'll change. But one thing also that we're starting to see is the stock market. If you look at it on a monthly basis, this is the Dow Jones. This is down 5.25%. If you look at it on a 5-day basis, down 2.43%. And it was down yesterday. It was down yesterday, 453 points. It's not even up on a monthly basis. You have to go back to a 6-month basis. And year to date, it's down 1.17. So if you invested in January 1st, even though it was up for most, if you had to cash out today, you're down. So on a year to date basis, and then let's look at the S&P, same thing, that's down 3.23%. On 5 days, 1.54, 1.3, and a year to date, that's down 1.54. And I don't think it's solely the Iran war. The economy, and you have to remember, most people believe war is good for the economy. But the thing is, we don't have a manufacturing base anymore, so all those things don't remain true anymore. But the U.S. economy lost 92,000 jobs in February. And last week, they were all overstated. Let me see. And look at this. Revised January's down. So it was only like 4,000. It wasn't that much. And they also revised December's down to a contraction. So that's 2 out of the 3 months are a contraction. So if you look at this is not a good. Gosh, why did my computer have to slow down? This is not good. And I think what this is they can't hide the job numbers anymore. It's going to be impossible to create fictitious job numbers. So yeah, that's what I'm looking at right now. And then the last thing is I'm trying to, hopefully my computer actually, for some reason it's frozen. I'm trying to get onto the other, on the other stuff, but all right, so I'm just going to unshare and then let's share again. And I contribute this to the economy, but this is a big deal. And this is one reason we're going to see deflation in the U.S. is Americans are leaving at the U.S. in record numbers. And is it becoming the country of e-immigration, which I think is true? Last year, this hasn't happened since the Great Depression. But here's what the other thing. Americans' own citizens are leaving in record numbers, replanting themselves and their families in lands that they are finding more affordable in states. So yeah, if you look at that, we are seeing, and this isn't a one-off. This is going to continue for the next decade or so. Or, as I said, immigration is always done at the expense of the native population. It's not good. If I ran things, there would be a moratorium. Unless you moved overseas for a couple of years and married someone, that would be the only exception. Can't find an employee, you don't get to look overseas, you just got to do it yourself. That's how I would look at it, because this country's full. Everywhere I go, it's massive traffic. Everywhere, like jobs, you apply for like 200 people. But the thing is, when you immigrate, a lot of people, eventually people are going to leave because it's just too many people. And so this is the trend that I've identified. And I think I'm the only one who I've identified this, is that you're going to see a lot of people now leaving. There's going to be a mass exodus of people. and it's a lot of it's cost of living, bad economics, too much competition. You just can't do that. I mean, it's not too much competition for anything. Where it's like going out to eat, 40 minutes wait. Well, now a lot of restaurants are open, empty. But any type of job, even like low paying jobs, even I remember at one point in the 90s, if I needed to get a summertime or a part-time job, I could easily get it. If I needed a weekend job, I could easily get it. Even a couple years ago, I had to bartend to get. I could easily do it. Now it's like there's nothing. It's this country's full. But so going that, but getting back to the markets, I think oil is going to go up more. It could go up to 150, 250. What I think will happen is there'll be a demand destruction. People are just going to just completely stop buying a lot of stuff. Oil and gas, if you look at this, 2011, if you look at it, that the market did not perform all that well. And that's because oil went over 100. So if you look at this, the stock market was characterized by extreme volatility and a flat overall performance. Sharp summer sell off. And that's when oil broke over 100. And then what happened? Obama unleashed the strategic petroleum reserves. And that was 2008 was the other spike. And even in 2022, look, it's worst year since 2008. And you can see it now. If you look at the last week, the last month, there was the Liberation Day with the tariffs. But I think, and if you also look at this, this is the other thing. This is why I think, well, let me see. Let's see, 10-year interest. I'm going to see if I can. Let's see. So, yeah, if you look at this on a weekly, interest rates start at 4.05%. Now they're at 4.138. And that's because of these oil prices. And then you can see on Friday it went down, but the oil prices sort of kept them in check. So I think as this oil price keeps going up, inflation will drive yields up. And that's what's sort of happening. So once again, just my opinion, not investment advice. I'm sort of in cash right now. I'm not really buying anything. I have some juniors I might want to buy if oil takes a dip or a dive. But yeah, I think this might be the year where oil plays catch up, and then maybe 6 to 12 months from now, we might get that recession. Who knows? The job numbers are looking horrible, and I think they'll continue to look horrible. They've been looking a lot worse. It's been a slow trend, but it's coming. So, anyway, that's all I have. Hit that like button, subscribe, and I will just remember this is not to be construed as financial investment advice. And I will see you next video.